Hello, hello. Happy Wednesday. Welcome to Live at 5. My name is Jeb Smith. I am a real estate broker professional here in Southern California. With me, I have Josh Lewis. For those of you who are new to us, he is our mortgage expert, and we're here to answer any real estate mortgage related questions you have about the housing market. Anything we can do to help guide you through the process, make the process a little bit simpler, explain anything in more detail. That's why we're here. So if you have questions, do us a favor, put them in the description below. Josh, welcome to the show.
Thanks for having me. I'm excited. It's the second show of the year, and we have one of our Hall of Fame viewers, Joey Crack, back in the house.
Oh, is
And
he here?
I get to ask the question, have you bought a house yet?
Oh boy, if he hasn't, he's paying more money for that house. But let's talk about that real quick, right? So we're going to talk about some things. We're going to talk about everything from interest rates to some increases in fees with regards to second homes and investment properties. I start the show every week off by talking about inventory in my local market, right? We're the second week of the year. Everybody talks about inventory picking up. Hasn't quite picked up yet, right? So today in Orange County, where I sit, 1,037 properties. We got as high. I saw 1,100 at some point this week. So at some point from the beginning of the year, we started, just over 900. We creeped up 1,100 or so. Now we're back down a little bit here in Huntington Beach. As of today, 77 active properties. So, and I saw us this week as high as 80. We're back down a little bit. And as of today, I think we had 6 active properties come on the market. So even with 6 new active listings, we're still not really gaining any traction because homes are going into escrow pretty quick. But we have seen some changes. We have seen some changes in interest rates. I talked about it, in a video earlier this week. Barry Habib, probably one of the most followed gurus with regards to mortgage-backed securities and rates in the industry. Anybody that's in the industry knows who he is. But we're going to spend some time in talking about, some charts and some things that he has mentioned. And as I mentioned in the video, just to kind of confirm it and kind of give you some ideas of where things are going. So Josh, we saw rates go up. We saw them as high as 3.625. Maybe give us a little bit of update and kind of, we'll queue up some charts.
Yeah, so one of our other normal, regular viewers here, Jose Negretti, pipes in with rates have been going up this past week, and they've actually been pretty level this calendar week, Monday, Tuesday, Wednesday. The big hit was last week, big spike last week. So in looking at that, the questions we always want to answer for people is, what does this mean in the big picture? Every time we have one of these new all-time lows in interest rates, and then it turns around and rates start going up, the doom and gloomers and just human nature is you're more worried about the thing that's going to kill you than the thing that's going to bring you a bunch of pleasure. So in this sense, the higher interest rates, as a potential home buyer, as a homeowner, people think, oh, this is the thing that's going to change everything. So we want to look, and when people start saying, well, now rates are going to normalize, they're going to go back to normal, the long-term average is 5.5%. Wanted to show some charts here that we talk about every week, but without you seeing them, it's a little hard to visualize and understand. So let's throw this big boy up here. So we talk about the 40-year bull market and interest rates. And this chart here is from the federal government. Their FRED system has a lot of awesome data. So if you're a data nerd like me, you can go in there and get lots of good stuff. But we talk about since 1982 here. It's about October of 1982 when rates peaked. This is a straight line down, but it's not a straight line. You can see here from 1983 to 1986, way down. And then we had them peak and then come back here. And then we had another leg down into the early 90s, and then up, down, up, down. So I should have drawn a channel here. What I wanted to show here is this trend line isn't exactly fair, but what I wanted to show here is from 82 through 2017 or so, we never really even approached this line. So that's a trend line. So when you're looking for a trend change, is if this line had come up and up into here, then maybe things had turned around and they could have gone back that high again, or coming in here and shot up above. That trend line has never been broken. So in a calendar
something to
year,
keep in mind, Josh, is you can't see your cursor, so you got to talk about.
oh,
Yeah.
That's not
Yeah.
nice. Why doesn't
Yeah.
it show the
So
damn
so so
cursor?
give them an idea of the year when you're talking about touching trend lines,
Okay.
just so
No,
you.
no, absolutely. So what we're saying here is if in 2000, if they had continued spiking up and gone above that green line, then maybe we would worry that there was a change. Now we saw here in 2018, it touched that trend line. Now I want to draw a more fair trend line to this 40-year trend because it has been challenged a couple times. Rates had gotten so high that if that time frame from say 1980 to 1984 is taken out of the equation, rates have never really been above 10%. So let's look, we go forward to 1986 where I started that green trend line, and you can see now, Jeb, is that cursor now showing up?
Yep. Yep. You're good.
That was weird. Okay, so from 1986 forward, this trend line comes down, and we touched it, pushed down, touched it, pushed down. So this is what we're talking about, where every couple of years we've had a refinance boom. Then rates go up, and then you have this nice run of refinances, and then rates trend up, and you have this run of refinances. Now in 2018, we actually broke above that trend line, and you were seeing lots of articles written. 40-year bull run in mortgage rates, interest rates is broken, and we're going to be going higher. And that does not, it did not, in fact, play out. And there's reasons for it. I have some boring data here that would put everyone to sleep of showing why that didn't happen. But the big thing we're hearing now, inflation is high. Rates have to go higher. This inflation is going to create this spiral where rates move higher. And we want to talk about where we're at, how inflation got so high, and what that means. So we've talked about it a little bit on the show. We had a ton of stimulus. So COVID hits, the government threw what, 3 rounds of stimulus for everyday Americans, some more for parents with children that just ended up here recently. So a lot of cash going into the economy. They bought treasuries, they bought mortgage-backed securities, pushed interest rates really low. So tons of stimulus. And at the same time, COVID is shutting down supply chains around the world, factories, shipping, ports. All of these things are impacted negatively. So we have an increase in demand due to the excess cash in the economy and nowhere for it to go because goods aren't getting to market. So at the same time, here's the best way that I can explain it. Every week we get questions here, people saying, hey, the Fed's going to start raising rates, or the Fed raised rates, Fed's going to move up because of inflation. The Fed is always behind the curve, and they should have moved much earlier. The hikes should have come last June, July, August. Not necessarily the hikes, but stopping buying treasuries, stopping buying mortgage-backed securities. Take that stimulus away. Then in the fall, they could have looked at a hike or two, maybe even just starting that now. But what the markets looked at, the bonds, meaning bond markets, treasuries, mortgage-backed securities, they're looking at these hot inflation numbers in March, April, May. The Fed saying this is transitory, it's going away, and the numbers keep getting hotter throughout the year. And last year, the Fed did nothing all year. So markets say, you know, there's a saying going back to the 80s, bond vigilantes. The vigilantes will go and take care of justice when the Fed doesn't move. So you see that they start pushing rates higher, selling bonds and saying, hey, if the Fed's not going to do anything, inflation's going to go higher, we're going to push yields higher, and that will slow the economy before the Fed ever even moves. So we had as Jeb talked about, we'll give him credit here at the end. Got a picture of his pretty face. Barry Habib. The funny thing is, I thought that I didn't remember exactly where this had been explained to me, and then Jeb and I watched the video of his forecast for 2022 here, and he laid this out as good as anyone can. So what we're looking at now is the Fed is coming in too late, and they're tightening. So if we look back on this chart here, so you see Burns and Volcker, those were the two Fed chairs, the late 70s, early 80s. Greenspan was late 80s into the 90s. We didn't even get Bernanke in here, but we have Powell now. So what happened in the late 70s to early 80s? Inflation runs up from 7 to 14%. In the 90s, it runs up from 175 to 3.5. In the recent times here, we went from 1.75 to currently 7%. Those are really high numbers. So
Why don't we just go to that last chart, Josh, so we can just walk it all the way through? I think it
we sure
explains everything.
we sure can. They'll jump ahead and look at it, but yeah, you can do whatever you want.
Yeah.
Mortgage rates jump 12 to 18%. Mortgage rates go from 7 to 8.5. Mortgage rates go from 2.5 to 3.375. So what does the Fed do? The Fed steps in and they raise from 11 to 20%, and it drops inflation from 14 down to 5%, and rates follow. You go the next step here in Alan Greenspan. They raise Fed funds from 4.75 to 6.5. Inflation goes from 3.5 to 1%, and rates go from 8.5 to 5.5 in the early 2000s. So we're looking here. Inflation goes from 1.75 to 7. Mortgage rates from 2.5 to 3.375. And we're actually up to 3.625 currently. And what are we going to do to the Fed funds rate? We're saying 3 to 4 hikes this year, run it up to about 1%. Inflation should drop, not just because of what the Fed is doing, but also because of the supply chain issues should work their way through. There could be some things that could make that take longer, and the stimulus is now gone. We're already seeing household savings decrease. So a lot of that spending has been spent. It's going to moderate. This will bring inflation in line. And once we start seeing inflation decrease, you're going to see mortgage rates decline. So we talked, in our forecast, late December, early January, we're talking about where can rates go this year. The 10-year treasury is probably going to peak somewhere around 2% or low 1.7s, 1.72, 1.74, somewhere we ended today. So that means we got about 0.25% higher to go on the 10-year treasury. What does that mean for mortgage rates? Over the last 12, 15 years, mortgage rates have averaged about 1.7% higher than the 10-year treasuries. It tells us 3.75 should be our peak. And if we go back to this chart here showing 10-year treasuries, and if you look at this trend, if we blew up into just this last part, you would see that trend line is right at about 2%. So 2% should hold as the cap here. 3.75 should hold as the rates. You see here back in 2018, it sometimes overshoots. So could the 10-year treasury go to 2.1, 2.2? Possibly. Could mortgage rates go up to as high as 4%? Possibly. I don't expect it to happen, but what you're going to see is the Fed's going to act. They came in too late. They're going to act too aggressively because they're tired of being told they're behind the curve. About the time that their changes, hikes to rate and removal of the stimulus kick in, you're also going to have the supply chain issues work their way through, and you're also going to have that stimulus effect gone, and we're going to end up in a recession because they're going to put too heavy a foot on the brakes, and you will see this trend line continue. So what does it mean for a buyer today? Don't fall prey to this thought that, oh, rates are going up and it's going to push home prices lower. The supply and demand equation that Jeb leads the show with every week is always going to take effect.
Well, that's something I want to talk about too here for a sec. So we'll go back to this question here. So Mahindra says, as interest rates went up, but didn't see the home prices fall, I assume still the same home price, but do not see some price reduction. Good thing is not went up. The price is basically what he's saying is that even though interest rates have gone up, he hasn't seen any effect on home prices. People, this doesn't happen overnight, right? It's if rates stayed where they are now, you still have to wait for supply to build. It still has to outweigh demand, right? As I mentioned a moment ago, we still have way less homes. I think you guys heard me talk last week. Here in Orange County, where I am, we have almost a third less properties on the market this year than we did this time last year. So think about that. Last year was a crazy year. Everybody was talking about we've never seen inventory this low. Well, guess what? Now we really haven't seen inventory this low. So it's going to take some time to work it out, right? Moving up 0.25%, 0.3% sucks, right? You pay more money for your mortgage. Some people are going to be priced out, but there are a lot of people out there that can still purchase property that aren't maxed out on their budget and see the direction of home prices. So just make sure if you're considering buying, remember, real estate's local, right? Depending on where you are, things might be a little bit different, but still don't stretch yourself. Don't get yourself in a position, even though what we just talked about is what happens historically, don't bank on you maximizing, putting yourself in a tough position to buy a house, financially with the expectation that you're going to be able to refinance in 3 months and get the payment lower, right? Maybe that doesn't happen. I mean, the chances of it, rates coming down are high, but maybe they don't. And so just make sure if you're doing this, you're making the right decision. That's all. I just want to make sure
Jeb,
we discuss that.
The simple explanation for that is supply and demand. There's a limited supply of homes and the demand vastly exceeds that. So there's willing demand and there's able demand. We've talked about, Jeb and I would both be happy to have beachfront homes here in Huntington. They're about $5 to $7 million. So we're willing, but we're not able to buy those homes. Now, what you're talking about is now interest rates are higher, those payments are higher. We lost some of that able demand. There is still way more willing and able demand than we lost in the last week or two due to these interest rates. It would take, we've talked about this. The economists, the experts have theorized that 3.75 to 4% would have an impact in putting a brake on the market. And we've also talked about that would be good. The projection, one of the last charts they had up there is where Zillow has Zillow and Pulsenomics do a home price expectation index, and they poll a bunch of experts every quarter, and they say, where are home prices going? And the most pessimistic ones were at like 3 to 4% appreciation, and the most optimistic ones were back up in the teens. That's problematic. If rates are at 4% and home prices go up another 10%, you will lose a lot of demand, and you'll see more of a supply-demand balance there. But if we get those 4.25 interest rates, that will put enough brake on it that we're probably only going to see a 3 to 5% increase this year, which would be healthy for the market, for those of you looking to buy.
So let's just talk about this for a second. So put in an offer earlier this week, right? Let's talk about some real world problems, if you will, some examples. So put in an offer earlier in the week for a buyer here in Orange County. Purchase price on the home $650. It's listed as a 2-bedroom, right, on title. It's actually a 3-bedroom. It does have a room that doesn't have a closet, but it could be a 3rd bedroom. So it's a 3-bedroom, around 1,300 square feet. Price it at $650, which in my opinion is low based on the comparables. Should be somewhere in the 7s. We made an offer at $750, $100,000 higher than the list price, right? Waived the appraisal because we knew we could support it with comps. We waived the actually we got an appraisal waiver, but we waived the appraisal, waived the loan. And guess what? We didn't even get a counter back. For one, because there were multiple cash offers and the property ended up selling over 800,000. Now, 800,000 is aggressive for that property in that area, but that's what happened on that example. Now, you might say, well, that's the lower end of the price point in Orange County. Of course, that's going to happen. Well, let's talk about another example. Costa Mesa. There's a property that came on the market for 2.4. I have some friends that use a different realtor, but they submitted an offer on that property above the asking price. There are 9 offers on that property. 9 at $2.4 million. We're talking 9, and it's a beautiful property and it's a nice area, but it's like that's not inexpensive real estate, and you're still getting that kind of demand. So again, supply demand until that demand calms down. Now, what happens when the next one comes on in either of those neighborhoods, priced somewhere close to what those properties were sold for? You still have multiple people that missed out. And that's what I tried to explain to people last year, is that you still have buyers that didn't get an opportunity to purchase these homes because only one person can buy it and you got multiple offers. So that's why you're going to continue to see some craziness in the market. But again, real estate's local, local, local. I can't preach it enough. I just want you to make sure that you know what your market's doing. All right. We don't really have a lot of questions here, but we do have a comment from Joey. So we're going to get to this. He gave us $20. Didn't get his forever home, but he got a lily pad. He says, got an accepted offer on a condo. Just got the MOS. What's the MOS? Notice, I have no idea what that is. So maybe you can fill me in with MOS. But his question is, how often after you get to the point do deals fall through? So in my experience, deals fall apart after an offer gets accepted, primarily because of inspections. Something goes wrong with the inspection, right? Typically, if you've done your homework, not your homework, if your lender has done their homework and done their job properly, your loan shouldn't be an issue for the most part. So rarely in my experience have I had a deal fall apart because of a loan. It's usually because something's in the property that is scaring the buyers, or the seller won't fix, or we can't come to an agreement on for whatever reason. And so people decide to part ways. But there's something in your statement here that I want to make people aware of, right? You didn't get your forever home. That's okay, right? I mean, I don't remember how old Joey is, right? Our age, Josh. I mean, you're older than I am, but I mean,
I'm 23. So
most people, most people aren't buying their forever home in their 40s, right? I mean, your forever home is typically later in life. So you got to get that stepping stone to be able to get there. So just, don't sacrifice on the things that are important, but it's okay not to get the perfect one right to start with. So anyway, and you were going to say something, Josh, before we dove into that.
No, I've got a couple of them
Memorandum
here.
of sale. That's
Yep.
what it is.
So there's a couple of comments here. So Realty pipes in with, I feel one of the biggest issues is wages. Wages are not even close to current inflation numbers. And then he follows up with another one here that we'll get into, that there's kernels of truth to them, but when you say something that's not backed up by the data, you sort of reveal what your thoughts are. It's helpful that if there's another side to the coin, that you research it and see what that looks like. What I want to do is just pull up real quick the chart here that actually shows what wages have done. Like, the wages have actually gone up. That's part of the problem with the inflation. Like, this spike, our average hourly or median usual weekly earnings spiked during COVID because the people that were working more hours, blah, blah, blah. But just follow that trend line. This is from 2010 at the end of the last. Wages have gone up consistently. And you see, especially on the low end, wages are going up a lot.
Well,
we've seen the numbers.
That's something I want to talk about here, right? I think if we took California and some of these high cost states out of the numbers for the country with regards to home prices, the majority of people being affected by not being able to get a home are in the lower price points. And what I mean by that is California and New York and some of these areas with, multi-million-dollar properties skew the numbers. But the median home price is around $350,000, right? So that's where a lot of people are affected, is in that lower, that 350 median price point. The people that are getting the biggest bump in wages are the people that are likely buying the median home price homes, right? So that those people are making more money and, in theory, being able to qualify for more property. There's just no property out there. That's part of the problem, is that, again, and he went on to mention institutional investors buying up the market or screwing up the market. They're a small piece of the puzzle. I know it's easy to blame the big guys because, again, it sells news. The Blackstones, the Zillows, they're buying up all the property. We're going to sell 6 million something homes are going to close or did close in 2021. I could assure you they're probably less than 100,000 between all that institutional buying. I don't even know what the numbers are, but it's low. It's not even a percentage of it. Now, in your area, it might screw you up, right? If you're in Phoenix or some of these that they were buying a lot of property, it gets a little bit more difficult, but they aren't the root cause of the problem. There are multiple things going on here. It's a lack of building over a 10-year period that has created the majority of these issues.
Yeah, and we covered last week that part of the reason why home prices are so high is because we've been in this downtrend in interest rates. The downtrend in interest is going to continue, which will push asset values higher. But if you have $1 billion or $10 billion and you don't want to aggressively invest it, you want to get a yield on this. I was looking at a property the other day and I'm like, that doesn't make any sense. Well, if you pay cash for it, it was an $800,000 property. If you pay cash for it, you're going to get a 5% yield on the money. Well, where can you get a 5% yield? So these big hedge funds are looking at it the same way. It's like, we're guaranteed our rent yield. And if we're buying right, maybe we get a 5.5%, 6%. We're getting tax breaks on that yield coming in that pushes it a little higher. We're hopefully getting some appreciation on it. In the last few years, they got a ton of appreciation on it. So we've made an environment that incentivizes them going in and buying. And if you're in an entry-level market, it's making it harder. And you're actually competing against those institutional investors. And that sucks. So don't want to downplay it, that it's not in the macro, the nationwide market, it's not a huge thing, but in entry-level markets, it sucks, and it is a factor.
No, for sure. And I did want to go up and just and hit a comment here. B in LA was here last week. She got an offer accepted, opened escrow. So congrats to you. I think you're in LA. So here in California. So congrats on
How
that.
Did you figure she's in LA?
I read Korean. That's what that actually says in Korean. It's you can't, after watching Squid Games, I learned Korean, and I figured it would be helpful to read the subtitles. So that's where I'm at,
I
man.
don't know. By the way, I didn't want to know the magic that they dubbed Squid Game with, because if you go back like into the 70s and you would watch like Bruce Lee movies, like the dubbing was horrific.
Well,
Like
it was
in
pretty
Squid,
bad in this one, though.
no, in Squid Game,
Yeah,
you're like, I know they're not speaking English, but it doesn't look like crazy. It just must be the
the
way they're
plot
able to
line,
sync it up
the
better.
plot was good enough to get you thrown off a little bit.
No, I'm telling you. I'm telling
All
you.
right. So Chizzy Black has a question here, something that we kind of address often. New to the channel, love it. Appreciate you being here. Here's our current situation. We pay $725 for rent. The type of home we want will cost us about $3,600 a month. Should we continue to rent and invest the difference or buy? So we can't really tell you whether to invest the difference or buy, but let's talk about, you pay $3,600 every single month in your mortgage payment. Josh, what portion of that, how much of that you think goes towards principal?
It's at least $1,000.
At least $1,000. So every month.
Keep answering, and I'm gonna get a better number. But
Okay.
but go through.
So you have $3,600 that you're paying towards your mortgage. About 1,000 of that is going essentially in savings per month. So if you were to rent for $1,725, you definitely don't get anything for the $725. And you said invest the difference. Well, the difference is what? About less than $2,000, $1,900. So not only do you get the $1,000 in principal write-off, or Josh is going to get us a more precise number here in a moment, but you also get the potential mortgage, the tax deduction on your mortgage. You get to write off those property taxes. In addition to that, you gain appreciation, right? The chances of appreciation this year go up, so that, $3,600 a month. I don't know what kind of property you're buying, but if something goes up, if it's a $200,000 property and it goes up by 5%, that's 10 grand. So 10 grand in addition to the money that you've paid down over that period of time. Josh, you got a number?
It is right on.
Okay, about $1,000.
Yeah.
So $12,000 a year, you're at $22,000 a year that you made on that property by not waiting. And Josh and I have talked in this market, because things are moving. It's difficult to save as fast as the market is moving with regards to appreciation. And another thing, if you believe inflation's real, guess what? Your money in the bank is worth less and less as inflation numbers go up. So you're actually not necessarily saving as much money as you think you are by having that money in the bank. I see you got a chart here, something that you're gonna pop up.
I wish I had it. I don't think I can find it that quick. But one of the things that is counterintuitive, when you look at it, the average mortgage in the United States is way less than the average rent. And the reason why is there's no 30-year fixed rent. At $1,725, if that goes up 3% a year for the next 24 years, it's doubled. So you're paying $3,500. So the people that bought 20, 30 years ago, they have a fixed mortgage at a much lower amount. They're not buying in at the current markets. They have a tiny little mortgage, unless they did a bunch of cash out, that is at a low fixed rate, and they have a much smaller house payment. So in the short run, you have this $2,000 extra over time that dwindles, in addition to the factors that Jeb was talking about.
Yeah, and another thing to keep in mind, I mean, like, I'll give you an example. Actually, I haven't responded to the email. I got an email earlier today. Someone had reached out to me asking about rent control here in Huntington Beach. So they're renting a property here in Huntington Beach, and their rent went from $1,950 a month to $2,190 a month. So it was a 12% increase. And they're asking me, can they do that? And I need to go back and research the actual numbers, but I believe in the state of California, you can go up 5% plus the cost of inflation is what they can raise your rent in any period of year. So inflation went up 7%, or from 2 to 7. So up 5% plus another 5% in increase, or 7. I don't remember the exact numbers, but the reality is 12% increase in rent in that scenario. So with a fixed payment mortgage, that can't happen, right? And you get the benefits that we mentioned, potential long-term generational wealth, all that good stuff. So,
and granted, this time frame here that we are talking about has been extraordinary in terms of rent increases. They will moderate over time. There may be a 3 to 5 year period where they don't go up at all. But my dad's condo, we rented it out when he got married in 2013, and it was to a friend of ours, of Jeb and ours. And I looked back, he rented it for $1,700. The current renter is paying $2,495.
And that wasn't that long ago, people. That was like
seven years,
7 years ago?
8 years
many?
ago,
Yeah.
it's gone up 35% in 8 years, and that's not uncommon. You look at any number, and I feel like we're pretty nice about it. I don't push it. I would rather have a good tenant than have the absolute tip top of the market rents. And the same thing, the property I bought in Orange, looking and doing the market survey and seeing similar properties that came on the market 2 years ago for rent were like $3,100, and we're going to be getting somewhere 37, 38, $3,900. That's a 25-30% increase in a couple of years. It's a lot of money.
It is. It is. Johnny Co. Will these higher rates make people want to buy ASAP versus spring, summer? I definitely believe that there are people in the market that think that rates are going to go higher and stay higher. Clearly, there's a lot of people out there that believe that. And so that's going to influence people to pull the trigger sooner rather than later. Absolutely. I 100% agree with that. Just the question is, can you find the right property? I mean, that's what we talk about day in and day out is, can you find the right property? I mean, we talked about it last year and even back in 2020 is that you're going to see more inventory as more inventory comes on the market. And that sounds like a crazy thing to say, but there are people out there that would sell their house if they saw the right home come on the market. They're contingent for whatever reason. So they're a seller, but they're a seller in a certain condition when they see the right home. There's a lot of people like that. But until those homes come on the market, those people aren't sellers for one reason or another. So it keeps supply even more limited, right? You've never had these problems where, you haven't been able to at least sell your house and find something. That's what you're dealing with at the moment. There's just very few options. Now, if you're in a market where you've got tons of inventory, you think we're crazy, and understandably so. But if you heard me talk at the beginning of the show, Orange County, where I am, we have 1,037 active listings on the market, 3.3 million people. Huntington Beach, we have 77 active listings, 200,000 people. These are really low numbers. I mean, Orange County, a couple years ago, we would have around 7,000 active listings on the market at any period of time. And even then, it was just a balanced market. It wasn't a buyer's market by any means. So, think about where we are, and that's a big reason why you're seeing the craziness that we have seen.
And on this, Jeb, I just look back to last year. We sort of got a preview of it. Rates were really low at the start of the year. By the 1st of February, they started going up. And that's about the time around Super Bowl time, first or second week of February is when buyers really kick into gear and come out of hibernation. And that, the impetus for them to move faster. So we had rates going up, people jumped in last year. And that spring, the February, March, April of last year was just brutal. So I wouldn't expect it to be quite as bad as last year, but I would not at all surprise me to see more people who are wanting to wait till summer or later in the year push here into the spring and push prices higher again, even though paradoxically interest rates are up and their payments are going to be higher.
Agreed. Simple name. I'm curious, what about people going through a divorce with a home they lived in for 12 years together? Refied at 4% in 2011. Should I settle now or wait? I live in Franklin, Kentucky. So I'm assuming you mean sell now versus wait. I'm actually doing a video on this. It's going to come out Monday of next week. That, you got to have a plan. Sell and do what, right? What are you trying to accomplish? Are you going to buy something else? If so, then you really need to think about your plan. Are you selling because you think that prices are going to go down in the future? Are you selling? I mean, why are you thinking of selling now versus say 2 months from now? Is it because you need to settle to the divorce and the money's going to be split? I mean, there's a lot of questions here that could be answered to be able to provide you the right information. But either way, just have a plan, right? Don't just sell thinking that you're going to just take advantage of the market because prices are high. Know what you're going to do after that, because if you think you're just going to run out and buy another property, it might be tough. It might, especially if you're here in Southern California. There's a lot of people that have sold that can't find the replacement property. Maybe you think you're just going to sell and go rent something. Okay, similar scenario. It's tough. Maybe you're going to sell and move out of state. Another tough situation. There's not an easy answer here. So just make sure you're dotting your I's, crossing your T's.
little follow-up info. They followed up here because I believe my home is being overpriced by $25,000. Nothing is remodeled or redone. Was appraised for $138 in April of 20, now $172,000 October of 2021. How is that possible? Well, what are we talking? Is that a $34,000 increase? It's about a 25% run up. And nationwide, we saw 18, 19%, depending on whose index you followed last year, and higher on the lower price points. You're in an affordable price range. Those went up even more than higher priced homes because there's a lot of people trying to enter at the low end. So those numbers aren't even shocking.
No, I agreed. And how is that possible? It's possible because there's a lack of supply, and there is willing and able demand that's driving those prices up. So to answer your question, could it be higher in 3 months, 4 months? Absolutely. You got to figure out why you're selling and what you're going to do once you sell. If you have that in place, if you already have the property that you're going to move into, great, go for it. Take advantage of the market. A bird in the hand, right? The thing is, you don't know what's going to happen in 3 months. If you think you're going to wait because you're going to make even more money, maybe you do, maybe you don't. That's what you need to weigh out, right? It's never, it's not simple black and white. There's some gray in there, some unknowns, if you will. So just make sure you're thinking through the whole equation. That's all. Jesse, this is an easy one.
Yep.
Jesse asking, however, or great info as always. Appreciate it, Jesse. What's up with the $15,000 credit for first-time home buyers? There's not one at the moment. I can't see anything happening on this front for any period of time. There's just no reason for the government, for any body in power at the moment to provide a tax benefit to buy homes, right? The housing market's already crazy. Now, here's the thing. Midterms are coming up, right? People are vying for that election spot again. You might hear some craziness come up about first-time homebuyer tax credits, about some of these things. But understand, it's part of the process, right? Nothing's going to happen until it's voted on, it's passed, all that good stuff. And for the time being, it's not even something that's being considered, or at least that I'm aware of.
And remember, every time it's been done in the past, it wasn't solely to help first-time buyers. There's always a good excuse to do it because it will help people get into their first home. Home ownership is good, but it also has met the real reason behind it. The economy is not doing well. Home prices are down. We're trying to stimulate. No one's trying to stimulate anything right now. They're trying to put the brakes on. So that won't happen. And Jeb, I just kind of wanted to comment on this. Janet Santiago says the wages are terrible in Los Angeles, retail, etc. I just want to say that no one thinks wages are great. I've never heard anyone that I talk to that says, you know what, my employer overpays me. I go in, I do nothing, and I get way too much money. So employees always feel like they're underpaid. Employers always feel like they're overpaying. And I have a lot of self-employed borrowers. We have this conversation all the time. I'm going through physical therapy right now. My physical therapist owns his clinic. He's telling me how hard it is to keep therapists, to keep front desk girls, because everyone is getting offered a ton of money right now. We've seen the total workforce shrink, so there's less available labor. Some people are staying home. We don't even know why they're not re-entering the market, but wages, there's no way around it. In the last 2 years, we've seen wage inflation. And the good side is people will have more money in their pockets. The bad news is that gives them spending power that then gives businesses pricing power. So there's always this little balance here, but just want to look at it from both sides. I hear you. Everyone would like to make more money, and it's super easy to look and go, well, my waitress doesn't even get minimum wage and just lives off of tips, and she's awesome and amazing. All those things are true, but it is a market-based economy.
No, absolutely. Question here. Alex is asking, what do you guys think about the worker shortage situation in the construction industry and how it could affect the prices? So I read an article, I don't know if it was in the Wall Street Journal or one of these news publications over the weekend, and they were talking about, some of these builders not even being able to complete homes because of not of the lack of the construction workers, but of the material cost, right? Like garage doors, garage door openers, refrigerators, appliances, stoves, that they were having to, order these things in bulk. Like when they build a new construction community, like when it gets approved before they've ever paved the streets in it, these contractors, these construction companies are ordering all the windows for every house they're going to build at one time because it's a 6-month, 1-year lead time at the moment based on how the supply, how backlogged they are in this stuff. So that's the construction workers not wanting to work is a piece of it. Supply supply constraints and backlogs is a whole nother piece of it, because if you've got people that want to buy properties, there's a lot of people out there that are in contract on properties that aren't going to be finished on time for one reason or another. I mean, the article I read said that the city, I forget where it was exactly, but the city essentially had allowed them to close on the properties, provide a certificate of occupancy on those, and let the buyers close on them with temporary garage doors. They didn't even have garage doors on them because they couldn't get them. So all of this stuff is going to keep inventory suppressed for the time being. It's, we're between 4 and 6 million homes short, depending on who you read, who you trust with regards to the number of houses that we need to balance the current market. And I think it's about 800,000 or so a year that gets added to that number. So every year it goes up, they're building, they're not even keeping up with the current demand on it. So just it's a problem, and it's going to be one which again makes buying existing property, house prices rise. That's part of the supply demand constraints that we're talking about.
And it's unpleasant if you need any work done at your house. First of all, just the timelines. We have a landscape guy, a concrete stainer, and a stucco guy all coming to do work at my house, and they're all awesome guys. And it just, everything's delayed because they have more work than they can handle. So you can either pick someone who's not as good at doing the work, or you wait for the guys that are good to be available and pay what they want.
No, absolutely. Alyssa is asking, are prices going down since interest rates went up a bit? No, we talked about it earlier in the show. Prices aren't being affected yet, at least here where I am. In fact, prices are still going up. Crazy. I mean, I told you, I gave an example of a property that sold $150,000 over the asking price, and you can say it was priced low, but even where it sold, it definitely sold for more than I thought it should sell for. Even though I called what it was going to sell for, even though I don't know the final number, I said it was going to sell for over 8, and it did. So no, not at the moment. Christina Smallhorn popped in. So Christina's also got a channel that you can plug in to if you're looking to housing. Puts a lot of good information out there on affordability and some things that can guide you through the market. So check her out. What do we got here, Josh? Anything? We don't have a lot of questions. We got a lot of
Joey's
comments.
Monopolizing the question. He wants to know, what type of language should buyers watch for when reviewing a contract? If you are using the New York State Realtors Association contract, it's going to be boilerplate. And what I always tell people is, remember, the language in that contract is for your protection, but it's primarily for the realtor's protection. Every time a realtor gets sued or something big comes up and their association is made aware of it, their lawyers go back to the drawing board and work on that contract. So it's there to prevent lawsuits. So it is there to protect you. But Jeb, what are your thoughts when it's a boilerplate contract and not a one-off FSBO contract that someone's writing up themselves?
Again, I could tell you if it were here in the state of California, the things to as a buyer, you've essentially written the contract, right? I mean, on the seller side, if you were a listing agent, I'm sorry, if you were selling a home and you got a contract, there's a lot more that you should pay attention to in the contract than if you're a buyer per se, right? Because chances are, if you're a buyer in that state, you essentially have to use that contract when buying a property, if you're using a real estate agent or what have you. So I would say there's less to be concerned with in that market or in that situation. But, again, just make sure that your contingency timeframes are what you think they are. Make sure you haven't waived anything in there. The realtor didn't check any boxes that they shouldn't have checked with regards to, hey, I thought you said you wanted to waive the appraisal or waive the loan or whatever. And you're like, you didn't do that. Things like that can happen. And I'll tell you, with DocuSign, people don't read anything. They click that box and they've signed a 12-page contract in about 10 seconds. So yeah, make sure you've checked, dotted the I's, crossed the T's, and just gone through some of it. But typically, in our contract, the things that you can change are either boxes you can check or uncheck, and or the language is in blue versus the contract being in black. So it's very easy to see what is there and what's not there. But as long as you have a pro working on your side, you're probably in good shape. So not a lot to be worried about there. I missed this one earlier. Kalar gave us a $5 super chat, so thank you. Asked the process of buying a second home, vacation home out of state, pre-approved for a second, but can't find anything in Alpharetta and Cobb, Georgia. So if you're buying a home, a vacation home out of state, Josh, what's the first step, right? You got to be approved with a lender that does loans in that state for one. So maybe talk about that, and maybe talk about some of the potential fees coming up with second homes here if you don't close on that thing before April 1st.
That's the big one you got to be aware of, and I'll bet you some lenders start putting it into effect before then to not get caught on the wrong side of it. So really the process is no different, because again, we only do loans in California, and in a year we do 225 loans. We might see 3 or 4 of our clients come in the door. So if you're 4 states away from your lender, so you're buying in another state, you're in Texas, you're buying in Georgia, you can use a lender in Georgia, or you can use a Texas lender that's approved in Georgia. So the process is really no different. You're going to get approved, and then obviously you're going to have a realtor in the area that you're looking at buying. So not really any changes to the process. But what Jeb was hinting at is that you are going to have a gun put to your head here pretty shortly. I'll
That's a bit
pull up.
aggressive.
I will, as a second home buyer, you are either going to buy or you may not be able to. The FHFA just instituted a policy, a new loan level price adjustment for second homes. Anything less or 20% down or less is going to have a 4.125% loan level price adjustment. That doesn't mean the interest rate is 4% higher. It means there's a 4-point hit to your pricing. And
that's a lot if you don't know.
If we always talk about a point would usually buy your rate down 0.25%, or if you're willing to go up 0.25%, you would get a point credit, a 1% credit from your lender. That 4-point hit, you would say, oh boy, that's a 1% increase. It's way more than that, because the further you get away from that par rate, the rate that is 0 points, that the lender doesn't charge you or give you money, the further you get away from that, the more they want to charge for it, because they don't want these high note rate loans because they're afraid they're going to sell off. So that 4 points takes, if you're buying an owner occupied home with 5% down right now, you're looking somewhere 3.5, 3.625, 3.75. We add 4 points to that. It doesn't go to 4.75. It goes to about 5%, and you're paying a couple points to get it. So the option there then is to look for a portfolio lender, a bank or credit union that loans their own money locally in the area. So you would want to work with a lender that either works for a bank or credit union in the area and is not going to be subject to those. And you want to ask them, is this a portfolio loan? Are you loaning your bank or credit union's money? Or are you selling this loan to Fannie Mae or Freddie Mac? Because if so, you're going to get hit with that. And it's hard, because you're looking here of saying, I can't find anything I like, and we've got a short trigger. As Jeb said, it goes into effect for loans securitized by Fannie and Freddie after April 1, but lenders are going to move ahead of that because they don't want to have loans sitting there that they haven't actually shipped at that time and get stuck with that 4-point hit their own. So you probably have till the end of February to get something closed before we start seeing lenders put those into effect.
No, yeah, absolutely. I mean, good information. I mean, it's going to come sooner, a lot sooner than you think. I think lenders are going to add it on there, like you mentioned. But once you got the pre-approval, that's solid. The next step is you got to find an agent that works that market and has access to. Jesus, bro, put some tea in that thing. Has some access to homes in that area, right? Make sure you're working with a pro in that market. Just because you're buying out of an area doesn't mean you still need a pro in that market that understands the inventory, maybe has a way of doing some things to generate listings, right? I mean, if you have a specific area, community, whatever you're interested in, it's a lot easier to generate listings when you know exactly what you want. And if you're working with a pro, they can probably help you with that. I'll throw a link up here in a minute if you need somebody to get referred to do either of those things and guide you in the process. Let's see. Got Jennifer Lego. So Jennifer is our moderator here in the chat. She sent me a message earlier. If you scroll up, it looks like she might be wanting to quit. So she might not be the moderator next week, but for now she is. We appreciate her being here. So thank you, Jennifer. You do this all free of charge. No, she gets nothing, people, other than the authority to boot you people, which is probably quite fun. I would just boot people just for fun, but
you're out.
She's asking, is it possible to request the inspection report from a seller's agent if there is one? I see a property which has been listed with no contract since July. Who owns has the right to those? So absolutely. So here in the state of California, if we have a property for sale and a buyer does an inspection, in theory, you have right to that inspection. You do have a right to that inspection. And once you have that inspection, you have the ability to then provide it. You have due diligence as a real estate agent to provide that to any new buyers coming in. Now, here's what I will tell you is that if the buyer pays for that inspection and doesn't want to provide you a copy, doesn't want to have you share it, they can request that. They can request for you not to share that report because they've essentially paid for it. Now, there were some modifications in our contract recently that do address this, and quite frankly, if I'm being honest, I don't remember exactly what it was. I need to look at it. But in theory, if they have an inspection report, you should provide that, right? I would gladly hand you an inspection report that I had that another buyer did prior to you getting into escrow to save us all some time, right? You see what's there, make sure there's no issues going into it. So yes, they have, I'm blanking on the word, but they should provide you with that. So yeah, just ask. And maybe they don't have one. Right? Maybe they haven't been in escrow for whatever reason and just never had an inspection report. So maybe there's not one to give.
So, Jeb, another little anecdote. I made the mistake of looking over at my inbox real quick. A borrower who came from the show, you referred to one of your pros in West Hills here in Los Angeles. Nice house listed for $925. We wrote a $940 offer. Very solid, very well qualified borrowers. House goes for over $1 million. So it's almost identical to the situation you had and the agent that Jeb referred knew the listing agent, had a little bit of an in there. So for those of you who have the conspiracy theory that agents only work with their friends and give houses away, it doesn't
it doesn't always work.
You knew actually on the one in Garden Grove.
On the one in Garden Grove too.
Yeah.
And it went way above us. So it doesn't matter. And also he did note on that property, bad roof and a bad chimney, and it still sold multiple offers. So just keep in mind, we're 50 something minutes into the show, asking a favor. If you find any value so far, we've answered your question. You like Josh's hat. He is greater than I. Hey, listen, hit the like button, share it with a friend, subscribed, do whatever. Help us share this information. We appreciate you being here. And then also I will throw this link up there for anybody looking to get connected with a real estate agent, with a mortgage professional anywhere in the country. A lot of you don't know that. I mean, as real estate agents, most agents just do their job, right? They sell property and that's it. They get their license once, they do their continuing education every 4 years, and that's the end of their learning process, if you will. I'm one of those kind of a student of the game, if you will. So every year meeting with, top performing real estate agents all across the country, discussing strategies, discussing, just different markets, discussing what's working, what's not working, and writing offers and selling property, all that good stuff. Also part of a business coaching program with, top level real estate agents all over the country. That's how I know these people, right? These aren't people that I'm just picking out of a hat saying, hey, you're looking in West Hills. Let's see who I can find. No, these are people that I have a relationship with, have a database full of these people that I can refer you. And Josh on the mortgage side, similar situation, right? He has a lot of contacts in a lot of these states, and that's who we're sending you to. So if you need somebody that knows what they're doing, that link will get you there. It's also in the description. I'm not going to keep it scrolling here across the screen the whole time. So that's that. Let's go back to some questions here. So Jason, John, pretty close. If I live in my primary residence for 2 years, then transfer deed to LLC, then immediately sell the property, would the LLC assume the profit tax-free? So I would ask you first, why? If you've lived in it 2 of the last 5 years, why wouldn't you just sell it and take the gain tax-free? Because you have that capital gains exemption, unless you've done that with another property in the last 2 years. I guess the other situation could be that you made way more than the 500,000 or the 250 that you're able to write off, and therefore you want to shelter some of that gain. Josh, I don't know. My guess is the IRS would read into this pretty easily. and see that you made the transfer to an LLC, you sold it to avoid tax and probably get hit. But quite frankly, I don't know.
If someone structured it in a way that you could do it, it doesn't make the tax liability disappear. It transfers it to the LLC. Depending on how the LLC structured, it still comes back onto your tax return. So there's no way of using entities to avoid paying gain or taxes on your gains if they exceed the 250 and 500,000 exemptions that you have.
There you go. All right. Snowflake. What is Snowflake saying? There is not going to be any inflation long term. Impossible. The economy would absolutely implode. I do believe that statement. The big reset is the only thing to reset everything. So what's
And
a big reset?
Without going down that rabbit hole, I would agree 100% with that.
Yeah.
So we led the show off with that 40-year downtrend in bonds. It's going to continue going. Inflation will stay under control. Technology is deflationary. Don't even think back 20 years ago before iPhones, and then 10 years before that, before no internet, no laptops. Technology is deflationary. Aging population is deflationary. Excessive government borrowing is deflationary. So we have no concerns long-term about inflation, but that can't go on forever. At a certain point, whatever you want to call it, the Great Reset, all of that, it basically is where governments around the world just have to agree to wash away everyone's debt.
And that sounds crazy. It sounds absolutely asinine when you say it, because you're like, how could that happen? But how do you get rid of $31 trillion of debt just in the US alone? Right? It has to go away somehow, right? Does that happen? Maybe at some point it does. But that's the only way that anything, rates, any of that's going to move higher in the future, in my opinion. But that's a deep rabbit hole. We could go way down. We could get lost.
Yep.
My Korean, I only learned Los Angeles in Korean. So can you read this one for me?
No, I am not able to do that.
B in LA. Read that one for us and tell us what we're talking about here. That might not even be Korean. I don't know.
Jeb, the funny thing is we see this every week that people pipe in and say, buy gold, buy Bitcoin, US debt, the US dollar sucks. But the reality is every country around the world manipulates their currency. Most of them are pegged to the dollar. Most of them want to be weaker than the dollar. And we've seen these claims every time any bout of inflation or government borrowing pops up. And guess what? If you look back over the last 50 years, relative to other currencies, the dollar has not lost any strength. We are not doing anything that any other economy around the world isn't doing as well. China may be its own animal, but only because they're behind a giant wall that no one really knows what they're doing, and what they report and release is not the actual truth. So it's easy to go all conspiracy theory on this and say, but it's just, we're not doing anything different. And look at the trend over time. Put the US dollar against a basket of foreign currencies, and it hasn't weakened significantly in the last 50 years.
There you go. AJ, and L Fair took 6 weeks before we got a white microwave for the kitchen. 6 weeks for a microwave.
Try and get any of your appliances right now. It used to be you would go in and go, I want this sort of certain appliance, or I like this. I like the freezer on top. I like the freezer on bottom. I like the one that opens like an armoire. Now you go in and you go, what do you have? What can I have now?
All right. So we got a couple common questions here amongst people. And just going to read a couple of them and then we'll kind of talk about it. Shane says, what do you predict prices in the Sun Belt to do if rates keep rising? So we talked about rates rising and prices, looking to sell in Connecticut this spring and buy in late summer. So asking about a specific area with regards to prices. And now Patrick saying it's now a good time for first-time home buyers to buy before the spring summer frenzy begins. Here's the thing. It's really hard for us here in Southern California to tell you what's going to happen across the United States, right? Without knowing the areas in detail. I could tell you what's likely to happen here in Southern California. And I think nationwide, you're likely to see it's still an aggressive market for the most time, tough for first-time home buyers. Do I think it's better or easier now than a couple of months from now? Not necessarily. It might be even more difficult because there's just less property to choose from. I think you need some inventory, some options out there to choose from in order to make it easier. Maybe the spring starts to bring that inventory on. This is typically our time of the year where things start to move. It could be later in the year. If if demand, a lot of the experts in the market are predicting a very strong spring market, it to slow down the end of summer and slow down into the fall. And if that truly happens, then maybe the fall is a better time to buy because you might have less demand. But who's to say prices aren't higher then? So there's so many factors that play into it. You got to make the decision what's right for you, right? What's right for you might not depend on the market per se, right? Maybe buying now and just, doing it versus waiting is the better of the option. Now, the Sun Belt is one of those areas that did have a lot of institutional buying last year because there's people moving there to rent. You got a lot of sunshine. You have all of that. They're lower priced homes typically in that area, more towards that median home price. And I think those homes are the homes that are probably getting pushed up the most just because they're at that lower price point, nationwide. So I think those markets will continue to do well. Just my 2 cents.
Jeb, where that strategy of trying to beat the spring rush might work is in areas where there's a bunch of snow on the ground.
Yeah,
People
absolutely.
don't want to get out. Like here, we just talked about 2 of our buyers here in Southern California that just got crushed. They didn't beat anything by being out there writing offers in January. But this is a really important point I need to make here, Jeb, is that when you get to Charleston, make sure you go to Lewis Barbecue. I am no relation to this, but we had the good fortune of going there, and I dream of going back to Lewis Barbecue almost every day. So when you get to Charleston, make this your second home. It's the greatest place on earth.
Too good. We should get a plug for that.
Send it to them. Say, hey, can we get a discount when we come?
Yeah,
they will ship a brisket across the country. Maybe we could get one.
Is it cooked?
Cooked.
I don't want a cooked brisket. I don't think I want a cooked brisket.
They cook it, they vacuum pack it, they overnight it. So you can only get it certain days of the week because they cook it at the end of the day. You have it in like 14 hours.
Hey, I'm just going to throw this up here. It's a comment. Matthew just says your referral network rocks. Not only got a specialist in my next area of investment purchase, but a previous president and current serving board of the Midwestern Board of Mortgage Association. So goals. So good stuff there, people. We're not just up here talking heads and not providing any value. We got the value to back it up. Joseph Mari, if you and your spouse both work, but one wants to leave their job, should they hold off on doing that until after we get approved for a mortgage to get the best rate? Does it matter? So let's go a step further and say, after you close on the house, before you pull that trigger. But Josh, you got 2 incomes, somebody looking to stop working entirely. What's the conversation you're having?
That's funny. Okay, so he wants to leave their job. Should they hold off on doing so until after? So if you're switching jobs, a job switch is rarely a problem. If you had a massive change of industries, it could possibly be a problem. But just from one employer to the next, never a problem. Now, if we're talking about leaving the workforce entirely, just I'm done working, I'm checking out, it absolutely could be a problem if you need that income to qualify. So what I would say is get with your mortgage professional up front. If you don't have one, Jeb has a network. But get with the mortgage professional up front, tell them what you would like to do, provide all of your current information, say, here's what we would like to do. Is that going to be a problem? That's really the only way to know for sure. But we need to know, are we talking about leaving the workforce or just transitioning to jobs? But the transition is rarely a problem, but it can be a problem in rare instances.
All right. I'm trying to see here. Let's see. Krishna says, looking at main view homes in Monroe, Washington, the list price increased 0.7 months, about 3 to 4 months ago to 0.7 million, I assume. 0.7 million, about 3 or 4 months ago to 1.1 million now. $400,000 difference in 4 months. Sounds insane. Should we hold off a purchase for a year? So it sounds to me like you're probably buying new construction. If you're buying new construction, again, if you can get in on the early phases, we talk about this all the time, especially in a market that's going like it is now, and you have a locked in price, could be huge. It's like the people that, bought cars, for example, being built. See Teslas before, prices went up and this whole backlog. And now the prices are $10,000 to $15,000 more for the same car because of just sheer demand. A different price point entirely, but it's the same concept. I mean, that next car is going to, or that next house is going to be more money for the same house just because, you're buying it at a later time. So I would tell you, if there's additional phases to that development, chances are prices are probably still going to go up. Now, I don't know the Monroe, Washington area. Josh, you can maybe talk about that, where that is in Washington, if you're familiar with it, maybe give some insight on it.
I just pulled up Mainview Homes. The homes look wonderful, and Monroe is a really nice area. Obviously, everything's regional. You have to be comfortable with being in the Pacific Northwest and dealing with the weather that they have there. But if you like the Pacific Northwest, Monroe is a really nice area, and these are bitchin' homes. It looks, looked at a couple of reviews here for the builder that seem to say really good things about them as well. But yeah, what Jeb said is some people just got lucky. 700 was probably too low, as much as 1.1 million might be too high. But really, the only way to look at it is to just compare it to other homes in the area. Is there other new construction in Monroe to compare it to? What are resale homes going for? Does that gap seem too large? But it comes down to supply and demand. If there's enough people wanting to buy $1.1 million homes in Monroe, Washington, then they can get it.
No, absolutely. Willing, one of our, normal, I don't know. I don't know if Willing's normal, actually. One of our regular viewers here is asking me to explain PAR, discounted and undiscounted. And talking about a form. So we believe Willing is probably a processor in the mortgage industry, based on comments. But do you want to explain this question?
So
Is it simply?
there's not a simple and easy way, and HOPA, it's a high priced mortgage loan. You're basically having to make sure you don't fall into a different category. The key is just to avoid dealing with freedom. So you will fight with them for your clients for the rest of your life. So that would be my best advice. Get away from their form and not have to deal with them at all. Excellent rates, just nothing much else to recommend them.
All right, good stuff. Snowflake, do you guys know what rates baby boomers are selling, retiring versus property being handed down? Lots of property being held here. So I don't know the actual numbers there. I'm sure there's something out there that you could probably find, that gives an idea of that. Josh is probably looking for it at the moment. But the idea was that, the boomers were going to retire. It was going to throw all this property on the market. We've talked about it several times. It just doesn't make sense for a lot of these boomers to move out of the homes that they've lived in their entire lives. For one, it's expensive to move now, right? They can no longer buy that smaller single level home for less money. They're basically paying, it would cost them more money to buy the new property than it would be to keep the one that they have. So people are modifying property. You've got generational living now. So, kids are moving in with grandparents and a lot of things going on. In addition, that those homes are being passed down to family who's keeping them in some cases, right? I had somebody reach out to me recently talking about selling a property here in Huntington in a nice neighborhood. It was a 5-bedroom property. It's worth around 1.5, probably, give or take. And I was actually thinking about it for myself, just because of the area. I mean, because of the size of the property. And I reached out to him yesterday, and he's like, "Yeah, I think my sister's actually going to buy it." Okay, mom passed away, left it to the kids. Sister's going to buy it. Hey, smart move. Like, why wouldn't you take advantage of that if you had the opportunity? And there's a chance there to probably keep the tax basis too. So you're going to see a lot of that, right? There's, especially with, grandparents, boomers want to see, their families do well, enjoy the things that they work so hard to create and gain, access to, property and equity and all that stuff. And a lot of it's going to be handed down. Just depends on what people decide to do with it once they get it. You see anything on boomers?
No, it's not an easy one to look up. And the thing that I would say is it's all anecdotal, but we talk to a lot of clients. I have a borrower refinancing to get cash out of the home they just inherited, free and clear. Father left them a $1.2 million house, free and clear. They're going to pull $500,000 out of it, eliminate debt, and have money to invest. They've been buying rental properties of their own. They're going to buy some more rental properties and convert his home into a rental because it doesn't work for them due to distance to their home. They'd love to move into it, but just doesn't work for the distance. I inherited my dad's property in 2020. My sister and I partly for emotional reasons, partly for financial reasons. We don't want to sell it. It's my dad's place. He lived there for the last 30 years. I don't imagine that I would ever sell it. So it's not uncommon seeing people inheriting homes and keeping them. It's not uncommon seeing people age in their long-term residences because it's where their comfort zone is, and there's not a good, cheaper option if they're not moving out of the area. That, Jeb, we see that a lot in high-priced areas, Orange County, and it was more so 2 years ago. You could get a little arbitrage. You could move to a much cheaper area and put some money in the bank. Now enough Californians have moved to the other areas that they're not cheap anymore. So I'd say that will put a brake on moving out of the area as well.
Yeah, I mean, somebody commented on one of my videos the other day and talking about, taxes in Texas being at 2.75%, where they were looking, actually, I think it was Austin, and how home prices were no longer affordable. It was actually less expensive to stay here in California than it was to move there. So again, it's not always roses and sunshine and all the,
My
the
my
green
buddy
grass.
has a rad condo in Fort Worth. The value of it is half of what my house is. His taxes are twice what they are. And we went through this. He doesn't pay any state income taxes. So while we're working, I pay far more state income taxes than his zero, but then half of the property taxes. At some point you're going to retire, and those property taxes don't go away when your income goes away. So that's the trade-off. California, we talked about this earlier in the week, Jeb. California, all of the bad things people say about California are 100% true. All of the good things people say about California are 200% true. So it is a little bit hard to just pick up and go somewhere else.
Correct. It was 80 degrees yesterday, people. 80 degrees. Anyway, AJNL Fair says, are there any historical precedent in other countries where both higher mortgage rates as well as higher rising home costs happen simultaneously for a long period of time? So, Japan, I don't know. Like, was this any part of the savings and loan crisis back in the 90s at all? I don't.
No. Even if there was, so in the U.S., we already talked about this. We have 40 years of decreasing interest rates, and we've already talked about that's not going to change. So I wouldn't worry about, if you're trying to figure out what's going to happen in the United States, higher interest rates isn't part of the equation. But the important thing to remember is look at home prices in Canada. If you guys ever watch HGTV and they film all their shows in Canada, and you look at the prices and you're like, that's nuts. Canada, much more expensive than the US.
Way more expensive.
England, much more expensive than the US. US housing is actually relatively affordable. And probably if we were on stage, people would be throwing tomatoes and stuff at us right now for saying that. But US housing is cheap relative to most major industrialized countries around the world. So that's why we get foreign investment. It's why hedge funds are buying it. And you're seeing somewhat that normalized. So no, I don't think this data exists. And even if it did exist, the way mortgages and banking work in other countries is way different, and the way their home values fluctuate are different. So I wouldn't extrapolate from that what might happen in the US.
Yeah, I mean, and I would encourage you, if you want to throw tomatoes at us, to do it right now.
Just do it. Throw it right at the screen.
Do it as hard as you can, and let me know how it works out. Simple Name has another question here. What do you think about appraisals on homes that no appraiser actually shows up to do one, and basically just takes a picture of the outside of your home and tells you the value? Is that legal? Yes, it is legal. There are things called appraisal waivers that do happen with loans. But understand, these are on certain loans. You got to have at least 20% down. You have to have super high credit scores. In addition, they're using an automated valuation tool, like an algorithm, if you will, to see if the value is reasonable based on the data that they have in their database to even say whether or not they would waive that appraisal. So yeah, there are some cases, for example, like we just, we were going to make an offer, like I mentioned earlier in the show, on a property that was listed at 650. We were making it at 750. We were going to waive the appraisal, but we ended up with an appraisal waiver on that property because the buyer was putting 40% down, had great credit scores, had all of that. So it does happen, right? I don't think this is, again, going to cause any issues in the future, but it's hard to say, right? We're a long ways from finding out, in my opinion. Just a lot of equity out there, big down payments, right? If you're putting 3% down and getting appraisal waivers, or 5% down and getting an appraisal, a different scenario entirely. But that's not what's happening. You're putting at least 20% down, and like, for example, last year market appreciated 15, 20% in most markets. So A lot of equity there, people. You were going to say something, Josh? No?
Just asking if is it legal. Well, you can always get an appraisal. If the lender's not requiring it, you can always get your own appraisal.
Absolutely.
No one's preventing you from getting an appraisal. They're saying here's the option. And even let's say I'm doing your loan, Jeb's representing you, and I go, hey Jeb, great news, they're putting 30% down, they got 800 credit scores, we got a waiver. You don't have to accept the waiver. You go, no, I don't want that, and we do an appraisal on it. It is your choice. You are signing a document that acknowledges that, hey, no appraisal was done. It was the value was accepted by the AVM. But what I would say is that there's nothing magical about appraisers. So if you're getting a waiver, the automated system not only is saying, do we think the value is there? We think the value is there at a high level of confidence. They have a confidence score in there. And it says 90% plus, we believe it's within this range that makes the risk acceptable on a file. And anyone, in terms of one where they just do a drive-by and take a picture, drive-by appraisals are not allowed by Fannie and Freddie. You basically either have it waived entirely or you have a full appraisal. FHA requires a full appraisal. VA requires a full appraisal. Every jumbo lender that I know requires a full appraisal. Some second lenders or portfolio lenders may be accepting a drive-by appraisal, but for the most part, it's either the machine's coming back and saying the value is good or a human's going out and telling you that.
No, absolutely. Krishna gave us a $5 super chat, so thank you, Krishna, for that.
He actually told me that the $5 was to have you try to pronounce his last name correctly.
Visayaraju. Visharaju.
You just butchered my man's name. He wants his $5 back. He said, give the $5 to Josh for
that's what he said.
My good name.
Maybe he can give us the pronunciation in the chat there. Does the MLS tell you who purchased a home after settlement? I have a hard time believing individuals are the ones paying over asking price. Has to be hedge funds. People are not wealthy like that. Here's the deal. I sold 30 something homes last year. All of them were over the asking price. I'm pretty sure. Maybe there was one in there that wasn't. None of them were hedge funds. Just throwing that out there. But the MLS does not show that data, but tax records, here in the state of California, we actually have access to title records in this business. We can look up who bought a house, but there's a way for people to hide information, but typically it's in a buyer's name. It's not in a corporation or a company's name. So it's typically individuals buying these properties.
Jeb, something you said tipped me off to a question of my own that I wanted to ask. Even the one condo that you had last year that didn't sell for like 6 weeks, didn't you even end up getting over ask for that? Because a lot of time people pop up and they ask, oh, this one's been on the market for a month. Can I go in and cut their price? And we're sitting there and you had asked, hey, I'm not sure. We don't know. We don't have a crystal ball. What's going to happen with this? Sure enough, after 6 weeks, 3 people pop up. Or what was the story on that one?
I don't remember the numbers exactly. I think we priced it at like 710. Didn't move. It had, had a really heavy smoke smell in it. It was a complete renovation. Like it needed to be gutted. And it was a single level property here. And we listed it, I think it's 710, and we ended up 709. 709 is what we listed it at. We ended up lowering the price to 700 and then to 690. At 690, we ended up with 3 offers. It ended up being a multiple offer situation. The buyer ended up offering 710. So we sold it $1,000 more than our original asking price, like 4 weeks later, just because of demand in the market. So it was one of those situations that, just because it sat on the market, nobody was willing to give in, if you will. Everybody kind of knew, had their holding, their number, if you will. And so it ended up selling. I had another one like that too. And I think it actually sold for around the asking price. But it sat on the market for a couple of weeks, and it was a small little studio. It was only like 400 square feet, and we ended up getting the price for it, the actual listing price. It maybe more. I don't remember exactly, but yeah. So anyway.
So Jeb, this is actually a gentleman that I've been talking to, Stephen Yates. Is it easier to buy a new house in a new development or an older home? It's a question that we get a lot, and I'll answer the easy one here before you tackle that. Are closing costs cheaper on new homes, or is it still the same? Closing costs are going to be the same. You get into a weird situation with builders where they want to push you to their lender. Their lenders usually have slightly higher costs, and then they give you design center credits. So it's something you're going to have to, if you go for a new construction, you're going to have to pre-approve with their lender. They're going to require you to do it. We can compare it to our numbers and you can kind of see the difference, but they should be pretty much the same. Now, how about, is it easier to buy a new house in a new development versus an existing home?
It's a tough one. Sometimes the answer is yes. Sometimes the answer is absolutely not. Like what a lot of these new developments do now is some sort of a lottery, right? So you have to enter your name because of demand, right? There's people looking to buy new construction in a lot of these markets. Where's Steven looking again?
Near Modesto.
Okay, so Northern California. So my guess would be a market in high demand. A lot of these builders now do lotteries. So you put in your name, they build a certain number of homes, they pick out names, and if you are picked and you're in a position and you want one of those homes, you get to buy it, and you don't really have an option of putting in just an offer. So yeah, how it's working in other states, it's hard to say, because construction at the moment is being affected by supply chains, by construction workers, by so many different variables. I can't imagine it's going to be any easier to purchase new construction than it is purchasing existing construction, unless a development has a one-off floor plan that nobody likes or whatever. It's difficult. And if you can just go in and buy one, you might question whether or not it's the right community. Because, especially if everything else around it is selling. So not a straightforward answer, but I have done a video on new construction versus resale, some things to consider. So, if you search my channel, that will come up. I think if you search like new construction, there's some good stuff in there where I talk about, some things that you don't think about on, when buying new construction that you should consider, because it ends up being a lot more expensive. And a lot of times you end up being further away from where you really want to be, just because, there's usually a lack of land and they're building on the outskirts. Like here in Orange County, where we are, everything that's being built is super south and further inland, just because there's no land to build developments, large scale developments anywhere else. And so that's what you get.
Jeb, we have a wonderful comment here. You remember me saying that I've never heard an employee say they're paid too much. Carolyn pipes up and says, I guess you haven't met us government workers. We get paid to do nothing. I don't believe that. I've been to the DMV, some very efficient, friendly folks there that just get you right through at a reasonable pace.
They love being there, by the way.
Yes.
They
love their
being
job.
There. Let's see. Yahara says, how are you able to lower your monthly payment in the future if you buy a house right now that is overpriced and with rising rates? What would be your options if house prices drop in the future? So Josh, you get locked into a loan, 30-year fixed, payments $2,000 a month. At some point in the future, prices drop. You can't refinance it. Rates have gone up. Can you lower your payment? Is there a way to lower your payment? What are your options?
Depends on what type of financing. So with FHA and VA loans, they both have streamlined loans, refinance options that don't require an appraisal. So you can refinance them regardless. Last time we had this situation, 2009, 2010, 2011, a lot of upside down homes. Fannie Mae and Freddie Mac came out with special programs that allowed you, if you had a good payment history, good credit, that you could refinance your loan even though you had negative equity. But let's go back and remember, there's two assumptions here in this: that home prices are going to drop, that homes are overpriced and they're going to drop, and that rates are going to continue to rise. I don't think either of those are true, but both would have to be true for this situation to come to play.
There you go. Jennifer is saying 255 people watching. So when she did this, there's actually 274 now. May your thumbs up button be working. So it's really simple. Like what keeps somebody from hitting that? They hear this and they're like, no, I'm not going to touch that button. I just want to know. Hey, put it in the comments. Why wouldn't you hit it? You think we suck? Then why would you continue watching? That's what I want to know. I don't know. Help me out, people. Help me out. Help me understand the logic behind YouTube. I'm still trying to figure this whole thing out 2 years later. What do we got? Jordan saying, I'm building a home in Utah. Should be done June 2022 or before. $620,000. Plan to put $250 down. When should I lock? And should I possibly plan to pay points?
Let's take the easy part. Never pay points until we have a chart where the trend for the 10-year treasury is solidly above that long-term downtrend green line. And if you don't know what we're talking about, go back to the very beginning of the show. You never want to pay points. It's very tempting. Probably the best example I have is back in late 2018 when rates were almost at their peak, 4.5, 4.75, had an extremely well qualified borrower, 800 credit scores, 20% down. He did not like the 4.625 rate. He said, how much would it be if I put 2 points down? Okay, 2 points would get you 4.125, but you don't want to do that because rates are going to go down next year. You're going to get it for free. We went through it, and sure enough, 7 months later, he got a 3.875 for free. And then 9 months later than that, he got 3.125 for free. And then about 8 months later than that, he got 2.625 for free. Nothing has broken that trend, so do not pay points ever. The only time I ever want to see someone paying points is if they are going to lose their borrowing power. So they don't think they would be able to refinance. They're going to retire and not have income. Something's going to change. And they say, I want to set this as low as possible because I'm never going to be able to borrow again. So the tougher part now, when should I lock? Now, I just said, hey, we got a 40-year downtrend in interest rates, but within that 40-year trend, we've had 2 and 3 year periods where rates continue to go up. I think they'll be lower by the end of the year, but I wouldn't bet my life on it. Now, middle of the year, what did we say? June? I don't know that I want to make any bets on it. We've talked about this before. If you looked and asked what would be my option for a long-term interest rate, that's a 5 months, 6 months, it's a 180-day lock. Those are usually really expensive and require an upfront fee. So look at it, but unless you believe rates are going to be considerably higher, which we talked about, 3.75, maybe 4% being the ceiling for where interest rates can go, I wouldn't lock anything before 90 days before closing, and I would like to get within inside 60 or preferably 30 from closing, especially with the way building goes. We have a buyer right now that he was supposed to close 3.5 months ago. We extended the lock at about 6 weeks post-close, or it was post-scheduled close. We just said, we got to let this thing expire and we'll relock in 30 days. We waited 30 days, we relocked, and now we're on lock extension number 3 because the builder can't get their shit together and get the deal closed. So that's not common, but a 1 week, 4 week, 6 week delay is fairly common.
Good stuff. I just scrolled down and saw how many comments there are that we haven't even gotten to. So guys, I apologize if you're commenting down at the bottom. We're still pretty far up in this thing. So I never want you to have to pay for getting your comment answered, but that's the way this thing pops up to the top. So again, I'm not suggesting you do that. We'll do our best to get through these questions with some short answers, but just know if you've asked a question, it hasn't been answered, it's because there's a lot of these. Let's see. This is a good one. Reniel, Jeb and Josh, awesome live stream as always. Did they increase the loan cap here in Riverside County? Lots of house prices at 850 or more go on pending less than 2 weeks. So what are conforming loan limits at the moment in Riverside County, Josh?
I haven't memorized them yet, but 647, 200. So they went up a good chunk from last year. But 647.2 on an 850 purchase price, which there's a lot of areas of Riverside, San Bernardino, the homes are 850, a million two, and those are jumbo loans out there. Other than VA borrowers who no longer have a cap, they can borrow any amount with 0 down. FHA has even lower loan limits than the 647.2. I don't have that up here in front of me. But yes, they went up. They didn't go up as much as homes appreciated. So we're still in the same situation where most buyers out there are looking at a jumbo loan or a combination loan of a 647-200 first mortgage with a second mortgage. So I was semi-hopeful that we might get. Some areas don't get the full high balance loan, which is up to 940 and change now. But there's areas that get a portion of that. So instead of 640, maybe they can go to 7 or 750 or 800. I was hoping we would get some of that for the Inland Empire, but you got to remember, especially San Bernardino County, there's some areas that are way out in the desert and homes are really cheap. So that throws off the county median, and unfortunately, it's the way the government does it. I wish they would switch to doing it by census tracts. So if you're in an area like Rancho Cucamonga that has really high home prices, you would have high balance loans, but no one asks my opinion when it comes time to make these decisions.
I'm just going to comment on Willing's first sentence here. Jeb was raised by wolves in the backwoods of North Carolina, and he had a mullet while he was in the pack. A lot of truth to that, man. There's a lot of truth to that. Do I know you? Let's see. We got Joey. Joey's asking, how does one get started with investment properties? Is the barrier to entry simply the capital, or are there avenues to buy with low and no money down? For the most part, capital is the barrier to entry. There are some investment clubs out there that will take you under their wing, so to speak, and allow you to go out and find them property. And then you can become a partner on some of their investment flips, whatever, and get a percentage. And if you could be an investor, I guess that way. But for the most part, money, it's all about money. And I'm not aware of any investment properties you can buy with no money down. That obviously would be a disaster in the making with regards to the mortgage industry. But money's what's holding you back, my friend.
So, hey,
it's holding us all back.
The $24 million question that we get here all the time is, hey, I bought my house, value went up. Can I buy another house? So the easy button, especially in a rapidly appreciating market, is buy a house, live in it for a year or two, do some rehab renovations, value goes up, and then go and buy another one owner occupied. That's the easy button for doing it without the big down.
Too good. What products do you use on your beards? So I don't use any products. I don't let mine grow long enough to need a product.
Who asked the
Joey,
question? Where?
Joey Crack.
Joey followed up on it.
Yeah, I don't know. I do have a friend that's got like a nice plush beard, and it looks like Santa Claus. It's so fine, and I know he takes good care of it and the whole thing. But
that was my objective. Every time mine gets to this point, my wife informs me that I'm not going to have a long beard. You can have a short beard, but you cannot have a long beard. And I got that speech last night. So right about the time when I start figuring out what wonderful products would make it silky smooth and beautiful, my wife says, trim that.
I think we should do this. We should grow beards until home prices decrease.
Look like Rip Van Winkle.
Let's see. I'm not shaving until home prices go down, and just see what I look like in 3 years.
When you look homeless and you have no business, because people go, you talk pretty, but I don't care. You can't look like that and represent me.
My wife just commented and said, I swear Jeb's office looks like he's about to shoot a porno in there.
They haven't even seen the action lights.
It's too good.
Get the pink and purple rotating lights going off the back.
I'll throw it on in a second. Prathi, Jeb and Josh, how will the new high sales price affect the comps? When or if there will be a market correction in the future? How will the new high sales price affect the comps? One high sell in a neighborhood doesn't necessarily change the comparables, but it does give some basis for other people to list their homes at similar prices. And then ultimately what happens typically is values continue to increase around those properties and drive up prices. Now, Josh has mentioned many times, prices are sticky to the upside, which means that, if I buy my house for $1 million and you decide, what the hell, I'm going to sell mine for $950, and you think and prices get affected by the $950 value, I'm probably not going to sell my house until values get back up above whatever that number is, right? I'm not willing to let go. It's like a lot of people, stocks, right? If you buy a stock, if you've traded stocks for any period of time, options, whatever, there's this level of greed, so to speak, and emotion that gets involved, that you buy something at a certain price, you watch it go all the way down to whatever level and could sell it there and buy it back as it comes back up, but you hold on to it and then it goes all the way back up and finally it gets to where you bought it and you sell it. And then it continues to move higher. It's an emotional thing, part of the process. And typically people don't want to let things go for less than they paid. So I don't know that sales prices are really going to affect a correction in the future. I mean, it's hard to say what happens. What has to happen is supply has to increase, right? To a point where demand, it outweighs demand, and people at those prices have to be willing to let their homes sell for less than the homes did around them. At which point those people have an idea in their head of what their home is worth, right? Because they've been seeing home prices go up or whatever. So I don't know that it's going to have a big effect. Now, what happens is if people can't afford them, then you've got a whole different scenario playing in, but there's too many what ifs here to really give you any sort of guidance.
So we've talked about this before, Jeb. Home prices are sticky to the upside for the exact reason that you said. The only people that want to sell or are willing to sell when prices start coming down are forced sales. Someone loses a job, someone has a job transfer, someone has a death of a spouse, wage earner, that not fun stuff. Who else moves in a down market? We've talked about this. I'm kind of stuck because for me to move up, it's a big gap. Now, if home prices dropped 20%, I have a ton of equity in my home. Now the gap to move up to a nicer home is less. Or maybe you have an in and can make a spectacular buy on a property. You and I saw one over in the harbor that someone bought for $835 and it's on the market for $2.5 right now. And it was awful when they bought it and it's gorgeous now. So let's say we're in a down market and I get an opportunity to do something like that. And granted, it was $1 million remodel on that property, but you see what I'm saying? Someone gets a spectacular deal. Someone just has a smaller gap to cross. There's just much lower sales volume when the prices come down. We saw massive sale volume because of forced sales in the last downturn, and that was largely due to poor underwriting and bad mortgages, which we do not have right now.
All right, good stuff. I'm just finally getting down to where we talked. I talked about Jennifer leaving, and she's not going anywhere. So, I mean, that's how far we are behind here on comments, people. So
That's really
I
important,
apologize.
Jeb. It's also important, in case my wife is watching tonight, that Ashley says
She is
that
watching.
she loves our beards, and she's a woman and curious to what products we use. Epic Beards. So I'm going to take this home and replay it for my wife, even if she
She's
did
watching.
watch it. Even if she did, I'm going to go home and say, "See, I told you it's a nice beard."
All right. So this is a question, and this is the last one I'm going to address on dropping home prices, just because we've talked about home prices the whole show. Go back and watch it. We'll give you why we don't think that's going to happen at anytime soon. But bought a house in San Diego. If the housing market dips, theoretically, what is the process for lowering the property tax to match the new lower price? Example, if it dropped from 720 to 650. So here in California, during the last downturn, 07, 08, I don't remember what year it was exactly. You had a lot of homes selling for less than people purchased them at. There were comps everywhere to support it. With our county, you could actually file what's it, like a rebuttal, if you will, on taxes. You had to provide comparables, right? So I had clients reaching out to me, it was something I reached out to my clients and said, hey, listen, if you're trying to lower your property taxes, reach out to me. I'll try to help you. They basically had to fill out a form. You had to provide 3 comps of properties that sold for less, and they would adjust your property taxes accordingly. And they did during that time. There were a lot of people in financial distress. They did a lot to help out. Now, I don't know if that's typical of a normal pullback in home prices. Obviously, that was a economic disaster on many levels back then. So they were doing things to help people out. I don't know what would happen in the future if that's the case, but there is a form that gets filled out, at least here in Orange County, that goes along with that.
So it's California wide, and for those of you in other parts of the country going, what in the world are these people talking about? But a not so fun fact is, let's say your home in the next downturn drops 50%, and you provide evidence to the assessor's office, and they drop your assessment 50%. You essentially are no longer protected by Prop 13 because you're not limited to those 2% increases. You can go immediately back up to your previously assessed value. It's 2% per year that you own the property. So whatever the previous ceiling was, you can immediately go to that in a year. So those people in the last downturn that kept their homes and were able to get reassessed at a lower amount, they are fully assessed back up to where they would have been otherwise. But they got a few years of benefit from that, and a lot of people actually did.
Oh boy. So Willing wants to take Ashley, who likes our beards, to your pool and enjoy a full moon. So.
I'm scared because Ashley now scares me because she's speaking Willing 7 language. No joke. I bought my house, moved in on the new moon 8.8 Lionsgate. They're like, they speak their own language and they both understand what each other are saying.
Oh boy.
We may have a love connection. We may hear about Willing and Ashley getting married soon.
Maybe Willing has 2 accounts and is commenting from both. I don't
Talking
know.
to himself. I got
Maybe. There was a question up here I wanted to address. Somebody had it was a real question. What is it? Okay. David, is it harder to get approved for a third mortgage? One rental, live in one right now. Is it possible to buy another without selling? So third mortgage, Josh, is it any more difficult than the second or the first?
It's funny. So when I hear that, I say, is it more difficult? It's not for us. We set up the file, we run the debt to income ratio, and you either do or don't qualify. So does it make it the from a debt to income perspective? Yes, every one of those properties we need to cash flow. So you're doing an analysis on what are the market rents, what percentage of the rents can we give you, or if it's on the tax return, what are the net rents after the expenses, and then you take away the payment, the PITI on that, and then you have a net gain or a net loss that gets added to your income. So technically the file setup is a little bit more difficult, but it really comes down to debt to income ratio. And a lot of times people go, well, what happens if I want to buy another one? Because then I have these two mortgages. Doesn't that blow out my debt to income ratio? Unless you're planning on keeping them all as first, second, third home. No, if you're going to rent them, we're going to use the rent to offset those mortgages and either have a small positive or a negative, and it just goes into your income, and we use that in your debt to income qualifying.
All right. Where do I even go from here? There's so many questions, guys. I'm sorry that we're so far behind. Mr. Yang has a question. I have a mortgage question. Trying to get a HELOC. Own 5 properties, 6.25 market value, 3.9 mortgage. I have plenty of income, but B of A doesn't do HELOCs if I own more than $2 million in loans. So Josh, what is a recommendation for somebody looking for a home equity line in this situation?
So honestly, for the most part, your best bet is going to be local banks or credit unions. They have a better hand on the pulse of the local market, and that shouldn't be a problem for you. You may have to call 2, 3, 4 different banks or credit unions in your area. And I say that we can do HELOCs. I have lenders and sources for HELOCs. Generally, for well-qualified borrowers, the banks kind of use them as a loss leader just to build a relationship with you. And the credit unions are really good at this. Some of them are terrible, and some of them are really restrictive in their guidelines, but there's a handful of them out there that are good. So I'd look up a few in your area and just make phone calls and see what their guidelines are. B of A, wasn't it during the downturn, Wells just said we're cutting everyone's HELOCs, or was that personal lines of credit, Jeb?
It's happened a couple times. Like Chase did it earlier in the year, I believe. Was it not
Yeah.
this year, earlier last year, they cut home equity lines.
The big banks got burned so bad
Yeah.
on seconds in the last downturn. They're just never going to get aggressive on it again. And I don't know that local banks or credit unions are going to get aggressive. I mean, we had 100% HELOCs, 100% stated income HELOCs for people even with mid 600 credit scores. We're never going back to that crazy stuff. But in your situation, you got a lot of equity. Sounds like a nice portfolio of properties. Probably have good credit. Someone will lend you the money on the HELOC. It's just going to be a matter of a couple of phone calls. And on the broker side, normally I would say call a broker and they'll shop that loan for you. A lot of the best HELOC lenders don't work with brokers.
All right, good stuff. Christina Smallhorn came in here and gave us a $5 super chat. So thank you again, Christina. Mentioned earlier, another YouTuber. Check out her channel. Good stuff. She's the leader in the real estate space with regards to views and subscribers and all that good stuff. Really good content. So check her out. Let's see. She says we're still going. Yes, 2 hours. Last year, Christina, 96 hours of live we did. 96 hours. Crazy. We're nuts. Let's see what we got. There's so many damn questions here. I honestly have no idea where to go. No, this is here we go. Digital cash cow. This is something I looked at this morning, and I serious question. Would you ever consider buying property in the metaverse? They're flipping digital properties, boys. We need to jump onto the digital world. So I don't want to offend you, Digital Cash Cow, because I see your name is Digital Cash Cow, and we're talking digital metaverse. But I was scrolling through Instagram or something this morning, and I follow a lot of golf stuff because I golf, and they were selling houses around a golf course in this metaverse. And I thought, who in the is going to buy a house on a fake golf course? And people are buying these things. I don't know what I'm missing. I swear I'm 41, so I'm not old. I don't feel like I'm old, but I just don't get it, people. You don't own anything. There's nothing there. What do you? I realize you could sell it. but then somebody's got to buy it, right?
No, there's so many things that I don't understand about this. In the real world, there's scarcity. There is no scarcity of land in the metaverse. Like you can always make more, always build more.
But you can't even enjoy it. Like, I don't get it. Like, I don't, you got to
You
be
saw the
content.
craziest one that I told you about the other week, that someone sold a yacht for $850 million or $850,000. I'm like, a real person paid real $850,000 for a yacht. Like, what are we
I,
talking about?
I mean, if somebody can explain it to me and sell me, first, you're a really good salesman, like, or saleswoman, or whatever you want to be called. But hey, listen, I'm finally to the point where I'll consider buying some crypto now, right? Just because it's funny money. I don't know. Even though I don't really see value for it at the moment, I think the future could be there, especially with this whole metaverse thing,
No,
right? People could buy
no,
stuff like that.
th-
But
no, don't. Just be careful.
okay,
Like you're not understanding. These are real businesses doing real things. You're thinking in terms of Bitcoin, where there's not really a business there. It's a digital currency, and they were the first mover and have that. But most of these things that we're talking about, like I told you about helium, helium has these routers that you can buy,
no,
and then
that's a
you
whole different.
resell.
That I understand that
But
piece.
that's what most of
Yeah,
those coins are. You're not buying those coins as currency. I mean, Dogecoin is bullshit. It's digital currency that is based off of what? It's nothing. Eventually, it's going to be
you're
nothing.
you just got punched by somebody. Somebody just punched
Yeah,
the screen when you said
it's
that.
fine. It's fine. But if there's not a real business behind your coin, I would be worried.
Well, that's the metaverse. That's what I don't get, but we're off topic and we've lost time. I just want to say Seer Guru thinks the beards look good. So just so you know. Um, I'm looking for some viable questions here to help people. Um, here's one. Again, same person, J squared. I keep getting letters in the mail about buying one of my properties. What would you do? Vacant lot, waterfront, secluded. So
Bullshit.
here's my thing.
Bullshit.
Would you chances are the letter is garbage to begin with, but why in this market, why would you sell? I mean, again, maybe you're not even talking about selling it off market and just selling it, but why do you need to sell it? Like, if you've held it this long, what's the reason behind selling it now? Chances are, my opinion, is probably going to increase in value just because not a lot of land out there to begin with. Now, at least here in California, other areas a little bit different. Markets and what have you. So, got to figure out what's right with you. Do you need the money? If you sell it, what are you going to do with the money? It's an investment. Are you going to 1031, are you going to 1031 it into something else? Are you going to pay taxes on it? Like, there's a lot of things to ask there, but in this environment, I would not sell a property off market, right? I
No,
mean,
no,
there's no
not in
reason
any
to.
world.
I mean, you got to think, if one person's willing to pay you that price off market, how many people are willing to pay that price or more on the
T-
market?
Tell them the story about Billy's house when you listed Billy's house.
Billy's house, Billy. Oh, I mean, yeah. I mean, sold it for
But
what, 100?
the minute it hits the market, you have someone. What's the number to keep
Oh,
it
yeah, yeah, yeah,
from
yeah,
hitting the
yeah, yeah.
market? And you said,
I forgot about that. Yep.
we just can't. And it would have been a good number, but it wouldn't have been as great as
Yeah,
it
we
was.
listed it at a million 125. And I think they wrote an offer for like 1,040,000 or a million. We sold it for 1,205,000. So with multiple offers, and multiple people would have probably paid more, especially right now. Another one just came on the market that's right there. It's not even nearly as nice, but that's a whole different situation. Let's see.
Hey,
Go
let's go
ahead.
to this one, Jeb. Wesley asked this earlier, and he patiently waited over an hour as it got buried here. Why does it seem like there's more demand when there's less houses? Because shouldn't it be the other way around? Supply and demand have nothing to do with each other. It just so happens that due to demographics, low interest rates, any number of other reasons, demand is really high. Supply has been impacted by underbuilding, um, multiple things, people staying in their homes longer, baby boomers not moving out, so less homes coming to market. So the factors limiting supply are different than the factors boosting demand. It just so happens that demand is really high while supply is low. Do you have any thoughts on that, Jeb?
No, I mean, you nailed it. It's just right now, because there's a scarcity mindset to some extent, right? Their rates are going to go up. There's a scarcity mindset that people aren't going to be able to buy a house because prices keep rising. There's a scarcity mindset that I'm never going to find the right home. And therefore, people, when you get in that scarcity mindset, that fear mindset, people want to make moves. And so it creates more demand around it. It's like Black Friday shopping, bad, comparison here. But, you throw the $500 TV on sale for $100, it just creates this overwhelming number of people that want that sort of thing. And it's same thing in housing. There's just not a lot of it to choose from. And once it's out, right? Housing will never be completely gone, but it's just right now, there's nothing more can be built just because of all the supply constraints, the land. There's so many different factors playing into it. So, and even if it does change and when it does change, because eventually something will happen and it create a more balanced market. I don't know at which point you're going to see supply exceed demand, but when you do, that doesn't happen overnight. That's what I think people need to understand. It's going to take time for this shift to take place, right? It doesn't happen. And right now you're seeing home prices continuing to rise. So anybody out there that telling you the shift is already in place, the reset is happening now, it's not. It's not. We're ways from that ever taking place at the moment. Josh, I'm so lost. I just with questions. We just started.
We got a bunch. Let's just jump in. Andrew 1059. Would you cash out an IRA to buy a house? A first-time buyer. And the answer on this, IRAs are a little bit tricky because you literally have to cash them out. If you have a Roth IRA, you can pull your contributions out without getting taxed and having a penalty on it. 401ks are different. You can borrow up to 50,000 out of a 401k. I don't have a problem tapping into retirement funds. I don't love the idea of getting taxed and paying a penalty on it if it comes to that. What are your thoughts, Jeb?
No, I don't. I think you nailed it exactly. Yeah. So good stuff. So I talk about California a lot. Christina pops in. She's in Louisiana. So she comes in and says they have less than 100 homes for sale in her county. They usually have around 800 to be a normal market. So not just California, where I am, also happening Louisiana, right? That's a completely different market than where I am. I mean, entirely different from all levels, price point, everything, and experiencing the same type of thing. There's a lot more land out there than there is here in California by the coast where I am. And you're still having the same thing. So just keep that, in mind when you're out there looking. Somebody asked me earlier about, it's not even worth answering, I don't think, just because I don't really have anything positive to say, but I don't have a virtual reality headset. Christina was asking that. I can't, I don't know. I haven't tried it. Maybe I should buy one, but then I feel like I would be living in this. Like I try to be off my phone. I've got 3 kids.
What was the one we got for our Pixels a few years ago? That was fun.
That was like a VR. That was like the entry to VR headset.
It was fun for like a half hour, and then you're like, I'm kind of over that.
Yeah, that's kind of how I was. Like I actually like to go out and do things. Like I like to go physically exert myself, hike, whatever, run, surf, be outside. I mean, I guess you could do that in the metaverse, but that to me is not the same thing. So, and maybe I change. I don't know.
So Jeb, after your $5, Krishna comes back and gives you the cheat sheet. With the cheat sheet, can you say his name correctly?
Why Sia Raju?
Okay, I don't think you got it right, but you tried.
I don't think so either. And that was so long ago. He's gone.
Let's go through this one. What are your thoughts on over 55 communities, not just in South Florida, anywhere where everyone's moving to? And Barbara, you don't look to be over 55. Maybe that's an older photo, but I'm thinking you're asking.
Maybe she's a real estate agent and using her picture from when she got into business
from like 20 years ago, or she's asking about investing in 55 and over communities where everyone is moving to. But just in general, what are your thoughts on age limited communities?
I think they're great for the right people. You've got to be okay with that. Like we have a great one here in Huntington. Now I would go as far as to say the properties in there aren't necessarily great properties per se, but these communities, they offer a lot of amenities. They offer the ability to have companions and meet people very easily. There's a lot of activities to do. I think they're great. I mean, if you're at that point in your life and you're okay moving it, I think it could be pretty pretty cool thing. I mean, if
you were
if
asking
me and all my
week,
buddies lived in one of these things at like 70, I think it'd be pretty rad.
tear it up on the golf course every day.
Yeah, but
race your golf carts around. But you were asking the other week, remember someone asked about this, it was the villages, and that one, the villages in Florida is
that's
huge.
a whole different deal,
and those people love it.
Yeah, they have golf courses, they have everything there, and rad properties, like true single family homes in there that are, you know, on land and the whole thing. So yeah, no, I think they're great for the right people.
So
go ahead,
Jeb. Do you remember? So as long as we're okay shifting gears, do you remember when after 38 offers or whatever it was, when we were in this market last year, you got Lupita and her husband into a house, and we brought her on. You brought her on and interviewed her a little bit. She's back. She says, "Happy New Year. Hope you guys are doing well." It would be a good time, because this is kind of like deja vu. We're hitting spring buying. Rates are going up. People are jumping into the market. Crazy bidding wars. Maybe we have her on and just to tell people, what was your experience last year in a very similar environment, and what did you like? What did you do right? What would you do different?
Yeah, we could do something like that. Maybe plan some. I mean, I think here's the thing: is like the market is moving. I don't like giving discouraging information, because I think it's almost like spreading fear to some extent, and that's not the goal here. But the market is still moving very quickly, and it's very difficult to help people understand that when there's so many different avenues of incorrect information being fed to people all day, every day. Does that make sense? Like, for example, the property that I mentioned earlier in the show, 650 list price, we made an offer at 750. I more or less said it's going to sell for 800,000 in the conversation I had with them. Right. And for me, it's very difficult to push that, right? Say, hey, listen, if you want this, you've got to at least be here. And there's a chance even then they don't get it, right? Because there's multiple cash offers, sells above that, whatever. And so as a real estate agent, it's kind of you got to provide enough information, but also let people be able to take the reins a little bit and do their own thing. Make sense?
Yeah, Jeb.
Yeah,
and what I was thinking with that is, she's the poster child for not getting discouraged in a market.
No, 20 offers
when you can be discouraged. So I'm not sitting here talk about discouraged. When things are tough, you got to just kind of adjust and move forward. And she did that, and she benefited from it. I'm doing the same thing you were doing, Jeb, here, and scrolling through these questions. We've had times before where we haven't been able to get to all of the questions, but like, this is absurd tonight. Jeb, why don't you throw up the email, and maybe if anyone has a question they really would like answered, either we can queue them up for next week, or possibly get back to them here by email during the week.
All right, I'll do something here. And then you can also, like, I try to answer questions on videos. Like, if I put a video out that's not live and people comment, I usually try to go back and address questions. You know, the problem with lives is once the live shuts down, your question in the actual chat goes away. But if once the video is done from a live and it gets posted, if you go take your question and comment it on the video, it will show up as a comment, and then I can actually see it, right? Otherwise, I have to watch the entire video, see where the question is, and then go in and answer. And even then, you wouldn't see the answer to your question. So what I would ask is, if you have a question that hasn't been answered, when we hit the end broadcast here in the next couple of minutes, go in and put your question in the comment, and we'll get back to it. How's that? I think that's fair. And then we can even use some of these maybe for starting next week's show, because we do this every Wednesday at 5 o'clock, as many of you know. So we're going to do that. I'm going to throw up some email addresses for everyone here. So email addresses at the top. I would like to ask a favor for those of you who I didn't get your question. I can understand you not wanting to hit the thumbs up. So no argument there. But anybody else, hit the thumbs up, share it with a friend, like it, comment it, subscribe to the channel. We appreciate you being here. Josh can't even pay the light bill. Look, his light just went off.
I'm trying to turn mine into a porn set like yours, so I'm just going to flash the lights on and off.
That's interesting.
Hey, I got a reminder for you, Jeb. Digital Cash Cow. He sent you.
I
was looking. Send it to me, and I'll get back to him. So no, you're not.
I was just searching for his email.
There's options. So Jeb's going to send it to me. I'll get back with you. And
what's Digital Cash Cow's name?
I don't remember. He changed it. just type in LIBOR. He's been asked about
I
LIBOR
tried. It
for
didn't
a
show
month
up.
now.
Hey, you have my email. Send it to me again. Sorry.
You got my email. Just take Jeb out of the loop and send it to me. We'll
There you
figure it
go.
out. There's got to be an option.
Last thing, if you're still watching, need a referral, real estate agent, lender anywhere in the country, jebsmith.net/referral. It's in the description below as well. We'll connect you with a pro that can help guide you in the right direction. Josh, any final parting words as we're going through this?
Just be calm. Obviously, the market, it's the first of the year. Everyone jumps out with what their thoughts and hypotheses of what's going to happen this year. It's looking a lot like last year. A lot of buyers, not a lot of inventory, rates creeping up. Just be smart, be calm, and do what Lupita did. Be patient, keep doing your due diligence, get out, look at homes, make strong offers, do everything you can, and you'll get into a home. The big thing, last year, everyone was asking their questions about refinancing. For most people, if you have a rate 3.5 or below, refinance isn't in the cards, but we're sitting on record levels of equity. We have a lot of people reaching out about cash out. If you're looking to get money for other investments, to do anything, it's a good time to look at that. But really, this is just a year to be calm and see how things play out.
Good stuff. Good advice. Again, here, if you have questions, need anything, we're back next Wednesday live at 5. Appreciate you